Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, as well as one of the founding members of the Dividend Kings marketplace subscription site on Seeking Alpha. And I was inspired to write this article by a good friend and fellow Seeking Alpha author, Jeff Miller, who recommended everybody read an article by Safal Nivashak, and I hope I pronounced that correctly, I doubt that I did, on why value investing works. It's really an excellent little article. And in the article, Joel Greenblatt, one of the preeminent value investors, was quoted, and he said, value investing doesn't always work. The market doesn't always agree with you. Over time, value is roughly the way the market prices stocks. But over the short term, which sometimes can be as long as 2 or 3 years, there are periods when it doesn't work, and that is a very good thing. Now, he goes on to say the fact that the value approach doesn't work over periods of time is precisely the reason why it continues to work over the long run. Now, my contribution to this is an excellent article. It takes about 4 minutes to read. This is the whole article that I'm kind of scrolling through here, so you can read it very quickly. There's a link in the written portion that goes along with this article. But the real key is why value investing works is so critically important, and it works precisely because it doesn't work. And what that simply means is I think investors have to embrace the reality that there are times when the market misappraises stocks, either too high or too low. And being able to recognize that, first of all, is a very, very valuable aspect of being a successful long-term investor. And then even more importantly, exploiting these situations when valuations get either too high or, as it relates to the subject of this article, too low. But it also comes down to patience and trust. I call it intelligent patience. Okay, and Joel Greenblatt in that article also said that, it comes down to knowing what you're doing. And so the point is that when you're looking at common stocks, most people take all their direction from stock price activity. My argument is, and I'm going to try to demonstrate it here by using one metric. I'm going to go through several companies here utilizing only one metric, and that's EBITA. Earnings before interest, taxes, depreciation, and amortization. My goal is, as the Army taught me, kiss it, or as they say, keep it simple, stupid. I want you to understand the essence of value investing is owning a business that generates value for you over time. And when you can find that business at a market value that is below its intrinsic value, then you really have a terrific opportunity to make great investment returns. So I'm going to go through several very high-profile stocks. You can see them here on this portfolio review that I'm presenting here. I'm going to start with Apple and then go to Amazon. I'm going to go through them in alphabetical order. But you've got some, really super stocks here. Google, currently called Alphabet, Hershey's, Johnson & Johnson, PepsiCo, Starbucks, Visa, etc. So let's get going here and go look at these stocks. And I'm going to look at all of them through the lens of EBITA. Now, the reason I'm using EBITA, which again is earnings before interest, taxes, depreciation, and amortization, is because it's a close cousin to cash flow. It's also a close cousin to revenues, or the top line, as I mentioned in the written portion. In other words, it really gives you a good indication of how well the business does. So if I take price off of this graph and just look at EBITA in the case of Apple, you can see that they went from earning about 3 cents worth of EBITA in fiscal year 2002 to over $15 last year, and expected to be even more than that, approaching $16 for this fiscal year, which, by the way, ends in September. So when you put price on the graph, I want you to notice, you'll notice this with all these companies, that price tracks EBITA. But this first example just kind of coincidentally works because, as Joel Greenblatt said, EBITA doesn't always work, but it does work in the long run. And what I want you to see here, that Apple, based on its extraordinary growth of over 25% a year, has really been undervalued. The orange line would represent the intrinsic value based on an EBITA multiple, or a normal EBITA multiple of about 17 that this stock should or has commanded over time. But I want you to notice these periods of lower valuations where the EBITA multiples were much lower still allowed you to earn a significant rate of return. I'll just run a couple of calculations. Here's over 22% annualized rate of return if you bought the stock at that level. On the other hand, if you would have purchased Apple, even here when it was at a higher EBITA and held it to now, you would still be making over 15% a year. So the point is, value investing works because what you're doing is you're investing in the business. I call it business perspective investing. Now, another thing I mentioned in the article, and I want to be clear of, both Apple and Amazon would represent growth stocks. And I want to make sure you get the distinction between there is no such thing, in my personal opinion, as a value stock versus a growth stock. And that's two categories that the marketplace or the financial lexicon often tries to tell us. Value outperforms growth or growth outperforms value. Well, Amazon is clearly a growth stock. I mean, it's grown its EBIT. I'm using the EBIT example. I'll shorten it so I can get a calculation at over 34% a year over this time frame, which here goes back to 2009. And you can see that the price has tracked that EBITDA growth almost perfectly over this time frame. But now it sits substantially below it. So even though Amazon is clearly one of the preeminent growth stocks on the planet, I would argue it's also a value stock. Even though its price to EBITDA is relatively high compared to the average company, it's relatively low compared to its own growth. So here we have a position where Amazon is clearly a undervalued stock. And again, value investing works because really it is business-like. It's investing in the business and allowing the business to make you the money. And what I want to be clear is I often like to take price off the graph and look strictly at what the business is doing, because this is the kind of business you want to own. This is a successful business that is clearly growing and growing like a weed. And we go on now to a company called Ascena Retail Group. And this is a company that is in the women's apparel business primarily. And what I want you to see here is that EBITDA fell or weakened and the stock price fell dramatically. I'm not sure I would call this a value stock. And by the way, I want you to notice I've got no forecast for EBITDA here, but I did want you to see just the contrast without spending a lot of time there. Now, an article and video that I recently produced was on Broadcom, symbol AVGO. And again, using EBITDA, you can see that value investing works. When Broadcom got very inexpensive back here in 2018, it eventually moved back towards its EBIT. It's got inexpensive again, but the key is it's only inexpensive because EBITDA is still expected to continue growing. That's what makes it a value stock. It would not be a value stock if the actual earnings weren't growing. I'm going to bring in a stock that I covered in the written portion of this article to illustrate that a little clearer. You see, Avon is trading below EBITDA here at this point, and it was trading below EBITDA here in November of 2011. But the point is, it wasn't a value stock, and you weren't buying, a stock at a good valuation there because the EBITDA was collapsing over this period of time. And I really do want to make that distinction. Value has to be all about investing in above average company when the valuation is low. Now, to muddy the water a little bit, you could look at a company that's cyclical like Caterpillar. But again, value investing works. You can invest in Caterpillar when it's very undervalued during a period where it's going to have a good performance or an upcycle over the next several years. But you can even invest in it when it's undervalued during a period of time where you're still facing a down cycle as long as we eventually get another upcycle. So value investing works when you're buying a good business at a below average price. Now, Cigna is an extraordinary growth stock here. It's another one. It's actually a value stock based on its expectations for strong EBITDA growth going forward. So just because a stock is trading at attractive value doesn't mean that it can't still be a growth stock. Cisco is a classic example, and I wanted to show this one because this stock has technically been undervalued for some time here, trading at very low multiples of EBITDA. But once again, even if you bought this on the high end of its undervalued EBITDA level, you still end up making 8 or 9%. But had you bought it here, when EBITDA was trading at about, was at about, the EBITDA multiple was less than 9, you would have made almost 16% a year. So value investing works because if the business grows and you buy it when it's cheap, then what happens is as the company builds value, and let's review that. Let's look at Cisco in July of 2012, which is their fiscal year. They had $2.40 worth of earnings. All right, so let's go ahead and buy it on July 12th here. I can only get month end here, so I'll buy it on July 31st, 2012, where they had booked earnings of $2.42. But then their earnings went to $2.56. Had a down year, as you can see, but then earnings went to $2.73, $2.97, $2.98, $3, $3.69, and expected to be $4.27 this year. This is what's creating the value. Okay, and the idea that we have this earnings growth is what's actually producing the value. Now, the stock isn't really performing at this point from a price movement point of view, but yet if you'd have bought it back then, you'd still be making over 15% a year, which is a whole lot better than, I'll call it chopped liver. So value investing works because you're buying great businesses. Now, again, another example where you can buy a stock at an extremely low value. Here you're buying CenturyLink at 2 times EBITDA, but yet you would have lost a substantial portion of your principal, over half, and had a negative rate of return over the next several years because EBITDA shrunk. So value investing implies, as Joel Greenblatt taught us, investing in above average companies at below average valuations. And so this is not obviously a picture of an above average company. The company's been performing very poorly. So value investing is about buying growth at a very reasonable price. Now, CVS is a good example of a current company that I believe is significantly undervalued. You can see that it's trading at about 4 times EBITDA. Its theoretical fair value should be almost 8 times EBITDA, so it's trading half off, you might say. But we can also see a period coming out of the Great Recession here where CVS also traded at low valuations. But again, notice the earnings build here. EBITDA goes from $5 to $5.40 to $5.54 to $5.86 to $7 to $8 to $9, etc. And over that time frame, now it eventually got into an overvalued situation. The market misappraises stocks. It can do it on the high side, as it's done numerous times on CVS, and it can do it on the low side, as it's also done numerous times and is currently doing so with CVS. So being a value investor means not focusing on the price, but focusing on the value of the business by looking at, what I like to say, the top line, sales and earnings, because what you will notice if you dig into this deeper, here's a price to sales graph, that CVS has had also a very strong top line during this period of time that we're measuring here. So, this is close to that top line picture because it's earnings before interest, taxes, depreciation, and amortization. But again, value investing implies trusting the orange line more than the black line. So let's go into Ford now. This is an interesting case because here you had a stock that appeared to be very undervalued at a price to EBITDA of 1.8, but yet had you bought it and held it for all these years, you'd actually lost 43% of your money. This is not value investing. This is investing in a losing cause. Value investing implies investing in above average companies at below average valuation. But as I pointed out, even a growth stock, a powerful growth stock like Facebook, can simultaneously be a value stock. It can be undervalued relative to how fast the business itself is actually growing. And here you have what's called now Alphabet, but is also Google. Now, this has technically been undervalued for many years based on this thesis that EBITDA is what's creating the value. But regardless, if you bought it at almost any time during this time frame, you'd have made very, very attractive return. Here you've made 20.5%. I'm just arbitrarily picking numbers. Here you'd have annualized 20.1%. Here if you bought it right at close to full value, you'd have been averaging 15%. So value investing is about buying above average companies at below average valuations. It's really that straightforward. And that's when you can apply intelligent patience. Now, I want you to see the flip side. Here we have Hershey, which is a very popular, high-profile stock. You can see periods where the market misappraised the value and the subsequent result. You can see coming in the recession, a period of 2 or 3 years or more where the stock was undervalued. But any of these time frames for the long-term value investor would have been a great time to buy this stock. And I don't want to measure performance to its overvalued level here. Measure it to what intrinsic value would be. That would be touching the orange line. You'd be making a 13% annualized rate of return in an A-rated, very high quality, blue chip dividend growth stock. Johnson & Johnson, again, a stock that was undervalued relative to EBITDA coming out of the recession for more than the 2 to 3 years that Joel Greenblatt talked about. But again, if you measure this from value to value, not the price, value to value, you make over 10% a year. When you can, and this is for a stock that's growing at 7.5. When you can buy a great business at a significantly low valuation, you can really make a lot of money. This is the one I used in the example in the article. There was a period of time here when valuation was real low relative to its intrinsic value, and had you bought it any time in here, and again, I want to measure it to what fair value would be, you'd be averaging over 15% a year. Now, had you bought it there, the market is overvaluing the stock today, in my opinion, where you're making about 19% a year. But the last time it did that, you could see, we had a rather precipitous drop. I didn't hit the top here, nor the bottom, but you can see that was a 10% drop. If I hit it here at the top and go to the trough, that's a 26% drop. So the point is, valuation is something you need to pay attention to, and you need to accept that the market will misappraise the value of a stock. 3M is a classic example of what I'm talking about. We had this tremendous undervaluation that lasted several years, but value investing works because as the company was building value, the stock price eventually reverted to the mean. But even when it didn't quite get there, here you're looking at undervalued to undervalued, you're still making incredible rates of return, almost 19% a year. In contrast, when the stock got overvalued like it did at the end of last year, you would have had, exposed yourself to about a 34% loss over a very short period of time, about 2 years here, because the stock was overvalued. Value investing works because it's all about investing in the business and not chasing the stock price. Now, even real estate investment trusts, here's the king of all REITs, in my opinion, Realty Income. And again, you can see that the great times to buy this is when valuation was low. But even coming into the Great Recession, you'd have bought it and you could have lost, almost 24% of your money in the heart of the recession. But had you held on as Realty Income built value, and I'm not measuring it again to its current price, I'm measuring it just to where fair value would be implied, that would be a 10% annualized rate of return. Of course, if you bought it when it was at the, near at or near its bottom, your rate of return then would exceed 13%. Value investing works because it's based on the principles of investing in above average businesses at below average valuation. Pepsi's another example of a company that went through an extended period of undervaluation. And, these would have been great times to buy it because value investing works, because when you're buying a stock at less than its intrinsic value, you're positioning yourself to make a lot of money. Procter & Gamble, another example. And once again, I want you to notice we now have a stock that's being significantly overvalued for no real apparent reason, in my opinion, other than investor exuberance here. But you can also see a period where it was undervalued for a long period of time, which would have been an excellent time to be investing in the company. Starbucks, a classic growth stock, but yet it's also been a classic value stock over many times during its history based on EBITA. When you buy it when it's really undervalued and you measure it out to fair value, you can make extraordinary rates of return. Of course, in this case, you get lucky enough to have the market overvalue it and you still hold it, you make 33%. Of course, now you got the challenge of, should I or, sell it or not. Growth rates are relevant. Here's a low growth stock. EBIT is only growing at about 4% a year. But once again, you see the significance of buying a company when it's undervalued relative to its intrinsic value. And then, of course, Visa is a very popular stock. There was a time, and I actually invested in Visa during this time, when the company was an undervalued growth stock. It was a value stock by my definition of value back in 2011. Today, I consider it an overvalued stock. But in the meantime, I still hold a rather substantial position and have done quite well in owning the stock. So value investing is all about ignoring the price and focusing on the business. And it works, and you can trust that it will work, and you can have the patience to stay the long run as long as you focus on this orange line, as long as you continue to see this orange line or the business results performing the way they should. Anyway, I hope you enjoyed this video on why value investing works. If you like what you saw here, don't forget to subscribe to our YouTube channel. I've enjoyed sharing this with you. I hope you found it of value. Thanks for watching.